This week on GTB, a regional escalation has turned into a global oil shock. In under 10 minutes we'll run through the facts. Who struck, how the respondent state reacted, the impact on maritime flows, and most importantly, which numbers and indicators investors and businesses should be watching right now. Over the last 48 hours Brent spiked to an intraday high of about $82.37 per barrel, then settled into the $77 to $78 range. U.S. crude, WTI, peaked around $75.30. Daily moves reached roughly 6 to 10% in the first days of the shock, while markets saw flows into safe havens and a jump in marine insurance premia. Major newswires and trader reports recorded these movements. Short chronology. Initial airstrikes and drone strikes, attributed in reporting to coalition forces, were followed by a broad retaliatory campaign of missiles and drones targeting regional sites and commercial vessels. Media reports indicate a number of senior leadership losses within the affected country, including, according to some sources, the death of the country's top leader. That development dramatically alters the balance of incentives and raises the likelihood of a forceful, sustained response. Eliminating top leadership is not a tactical strike on an asset. It is a political event that can generate prolonged, uncompromising retaliation. Domestic expectations and regime logic increase the probability that responses will go beyond limited strikes, and that changes insurer behavior, shipowners' routing decisions, and traders' risk calculations. To understand why prices react so sharply, remember 4 channels. Channel 1. The physical supply channel. Damage to a vessel or closure of a route reduces deliverable supplies in the near term, even if wells keep producing. Channel 2. The transport and insurance channel. Suspension or refusal of war risk insurance sharply raises voyage costs. Owners avoid risky routes or demand very large premiums. Channel 3. The futures and positioning channel. Hedge funds and institutions may increase positions in protective contracts, raising open interest and amplifying short-term price moves. Channel 4. The macro expectations channel. Higher oil prices lift inflation expectations and alter rate paths, which affect real yields and FX and feed back into commodity pricing. In the first hours after escalation, the insurance and physical delivery channels dominated. Ships either anchored or rerouted on long detours, instantly reducing available throughput. There is a hypothesis, and it must be stressed. This is a hypothesis, not an established fact, that some operations may have been timed to occur when markets were closed. The idea is that actions taken outside trading hours give prices a chance to settle before markets reopen, avoiding abrupt trading gaps and panic moves. This theory appears in analyst columns and social media, but there is no official evidence proving deliberate market timing. Treat it as a possible explanation, not a confirmed motive. Incident reports note damage to 3 tankers. 1 crew member was killed. Several oil terminals and loading lines partially suspended operations, and there were localized export interruptions at individual terminals. Estimates suggest these logistical stoppages translate into lost throughput equivalent to several 100,000 barrels per day in the short term, even while aggregate field production remains near prior levels. The oil market is as much about the ability to move barrels as it is about barrels in the ground. If a loading pier cannot dispatch a tanker, barrels stick at the terminal and immediate supply-demand balances tighten. The critical choke point is the Strait of Hormuz. Roughly 15 to 20% of seaborne oil trade transits the waterway. If traffic there is disrupted, owners must route around Africa, adding tens of days to voyages and reducing available tanker days. ICE tracking showed mass anchorings and congestion in coastal anchorages, hundreds of ships in a single day. Charter rates spiked and war risk premiums surged. This combination restricts deliverable supply even faster than direct production losses. Turning physical effects into price outcomes. Short shock. Days to 2 weeks. Spot Brent reached $78 to $82. With partial traffic restoration, prices can retrace. Medium shock, several weeks. If routes remain constrained and insurers don't restore coverage, Brent can move into the $90 to $100+ range, especially if SPR releases are limited and additional producer flows are constrained. Long shock, prolonged escalation drives systemic rerouting, persistent freight and war risk premium inflation, and global inflationary pressure. A sustained move above $100 is plausible under an extended blockade. Key indicators to monitor. The number of anchored or delayed tankers, as shown by ICE data. Public notices about war risk premiums and insurance coverage. Official statements by major exporters such as Saudi Arabia and Qatar. And inventory levels in major importers, including short-term commodity stocks in Asia and strategic petroleum reserves in the US and Europe. Fast market reaction means information changes price in real time. Watch shipping lane dynamics and data from major traders closely. Investors. Use short-dated hedges and assess the carrying cost of positions. Keep risk management flexible. Logistics and trading firms. Activate alternative routing plans, reserve tanker capacity, and renegotiate insurance terms in advance. Policymakers. Coordinated releases from strategic reserves and diplomatic pressure to reopen shipping lanes are the quickest stabilizers, though politically and volumetrically limited. Conclusion. We see a combination of military escalation and a critical logistics reaction, insurance constraints and ship stoppages, that instantly turned a local conflict into a global price shock. Brent has shown intraday peaks around $82, and with continued blockade pressures there is a credible pathway to three-digit pricing. In the next episode we will map the supply chain from field to refinery, identify the real bottlenecks, and calculate how many days of global inventories could be consumed under different routing scenarios.